Hello, everyone. In today's show, you're going to learn about three things: the value of the US dollar, the value of the world's reserve currency, which are not the same thing, and we're going to talk about stocks. All of this is about helping you understand how the wholesale creation and destruction of money affects your economy, your finances, our politics, our society. My name is Emil, Kalinowski. This is Making Sense, a Eurodollar University production. I am joined by Jeff Snyder, the head of global research for Alhambra Investments, the king of the shadows, a world-renowned shadow money expert. Jeff, good morning.
Good morning, Emil.
I'm excited. One of the things that you do best is explain what in the world is happening in the TIC Report. And the TIC Report, it stands for the Treasury International Capital Report. It's produced by the U.S. Department of the Treasury. And this report is not for the faint of heart, but it offers, as you often say, one of our best, unintentionally, one of our best views into the shadows. And you do a two-part essay, two-part blog post. They were both posted on August 18th at Alhambra Investments, and we're going to talk about those two blog posts. The first one is called Part 1 of June TIC, the Dollar What? And listener viewers, you can go to Alhambra Investments to read them. And what would you like to address, Jeff? Why did you want to write about the TIC Report?
Well, I think that what you just mentioned first is something that we should emphasize as well, is that the Treasury Department didn't start out and set out to try to quantify the global dollar system. This is, they've gathered this data together almost by accident, realizing that, going back to the 1950s and 1960s and Triffin's paradox and all of those things, that this dollar system, that the global reserve currency system of which the dollar is a part, at least under their academic understanding of it, they needed to at least try to quantify or try to get some kind of idea of what was going on out there between these various bank cross-border flows, short-term, long-term, all these various activities that take place in the world. And so they began collecting data in the late 1970s. And, it basically captures a lot of what does take place. But we also have to remind ourselves, because it's not purposefully, intentionally trying to measure what's actually going on, this vast Eurodollar system, it's only a small snapshot of what's going on. Therefore, we use the data as a proxy. It's not a full, complete, detailed, comprehensive view of what's going on in the dollar system. It's a proxy, but because it does seem to approximate what happens in the world and what we see in the marketplaces, the dollar, the movement of dollar, treasuries, all these various things, we think it's a very good proxy.
Jeff, it just occurred to me right now as you were explaining that yes, you're right. The first data of this report, the first month, is from 1976. And I suppose that's no accident. That's right during the middle of the case of the missing money with Stephen M. Goldfield. Do you think this was, so you're saying it wasn't a coincidence? They realized, hey, it's been 20 years since this Eurodollar system, Euro currency system has gotten going, and we need to know what's going on. So was it a coincidence? Do you know a little bit more about the who created it, who made this report happen, and why they did it?
Now, I can't tell you the specific history of TIC, but I will say that you are right that back in the middle of 1970s, there was a lot of official interest, let's say, in at least trying to get a handle on what was going on in the global dollar system. There were hearings in Congress, for example, on specifically Eurodollars. I mean, it boggles the mind given the fact that nowadays nobody's even heard of it. But for a while there, especially in the middle 1970s, which is where TIC came from, there was great interest in the idea that we need to understand all of these dollars, quote unquote dollars, that are going everywhere around the world. Where they come, what do they do? Who's doing what, and how are these things being done? And then, of course, interest in that kind of died away in the 1980s. But for a very long time, it was widely recognized and theorized that we better understand this thing before it comes back to bite us in the ass.
And it was because, I presume, because it was clear that inflation was getting out of hand and that the central bankers had lost the thread. Somehow that hasn't reached the politicians recently, but I'm sure it will. And one day they'll be watching this episode to try to get bone up on what they should be asking central bankers. You talk about the dollar. You want to talk about the dollar. You don't want to talk about the dollar, Jeff. You're sick of it. But you use the June report to make your case that the dollar is not down. Now, in episode 20, part 1, we explained the difference between the DXY index, which is what everyone's talking about, which represents the dollar, kind of, is down heavily, multi-year lows. But the other measures of the dollar are not down. Before we get into the meat of the TIC report, just a brief refresher. DXY, what is it? What is it saying versus the Federal Reserve's measure of the dollar and what that measure is saying?
Well, DXY is ostensibly a dollar index, but it's made up of 6 currencies, a basket of 6 currencies. In reality, it's not really a dollar index, it's a euro index. It measures what the dollar does against the euro, because I think you pointed out in that episode, Emil, exactly what the weightings were. So if anybody was interested, then go back and look at it.
57.6% is assigned to the euro in the DXY index, while the trade-weighted dollar, as reported by the Federal Reserve, assigns the euro only an 18.9% weighting.
Which is still a big weighting. But, the point stands. DXY is essentially a euro index. It's not a dollar index. And therefore, it doesn't really tell us a whole lot about the Eurodollar, which is what we're really interested in. Because when the Eurodollar system is malfunctioning, which we'll get to in part 2 of our TIC study, what that does is it drives the dollar index higher, or the dollar exchange value higher, whether it's in whatever index or not. And so what we're really looking at is if the dollar exchange value is going up, we can infer from it why it's going up. And why it's going up is essentially the stuff that we're interested in, which is the global dollar shortage. As you said at the beginning, monetary destruction in this offshore system. So DXY is essentially, it can be misleading in that it's so heavily weighted to the euro that if you only look at DXY, which is what most people do and what most people hear about, you think, well, the dollar's really going down, when in fact, most of the people around the rest of the world would say, what are you talking about? The dollar is still extremely high, and it's still a big problem.
Okay. So let's link the dollar now to the TIC report. And while you're talking, I'm going to pull up the article so that our YouTube audience can see it. And then I'm going to lead you down to a graph, and hopefully you can explain that graph to our audience. What's the relationship between the dollar and what you see in the TIC report?
Well, again, what we're looking, TIC is a proxy of the bank-centered activity that we believe is going on outside of the United States in this offshore system that's centered in the Cayman Islands and elsewhere outside the United States. And so what we're trying to figure out, of course, is whether or not that system is malfunctioning, whether it's behaving correctly, whether it's actually recovering for the first time in 13 years, or anything in between. And so we're using the TIC data as a proxy for that the condition of that system, and therefore matching that with what we also see of various prices in various markets, including the U.S. dollar's exchange value, because those two things often go together. So if we see the dollar's exchange value outside of the euro in the broad index going up, that tends to match up with these times in the TIC data, other banking data, and not just the headline TIC stuff, that tells us that something is malfunctioning in the global monetary system. And again, from the big picture perspective, some of the stuff is really simple. When we get into the details, yes, it's very complex, it's very detailed, and it can be often confusing. But from a very high level, it's pretty simple. It's basic economics. Whenever there's a shortage of something, you would expect the price of that thing, a commodity, for example. If a commodity becomes much more scarce, you would expect the price to go up, not down or in between or anything in between. So what we're really seeing is we're matching the times when the dollar price goes up and seeing if we can find evidence for what we're projecting as a scarcity in these global Eurodollars.
So at some point, you mentioned in that article that the Federal Reserve offered swaps to foreign central banks, and these started in late 2007, and they occur whenever something goes bump in the night in the Eurodollar system. The Fed offers dollars because there's that shortage that you were just saying. The dollar's going up. Why? Because there's a shortage of dollars. So the Federal Reserve very naturally calls up foreign central banks and offers them dollars. But here, I have a question here. This is the part I don't understand. And this is, I'm going to quote from your article. Quote, the U.S. Central Bank at the height of GFC2, which was in March and April of this year, after much of the system was already wrecked, changed the terms by which it would offer, presumably, U.S. dollars. And then in parentheses, you say, in the form of bank reserves, to overseas financial system participants clearly starving of them. Jeff, these swaps, are they U.S. dollars stacked into a nice cube on a pallet? Are they credits to a checking deposit-like account at a foreign central bank? Or are they, as you say, bank reserves?
Yeah, they're even worse than that, Emil, because it's not the Fed contracting with banks, even in this case. It's the Federal Reserve offering a deposit balance with foreign central banks. Then it's up to the foreign central banks to then parcel out those bank reserves that the U.S. Federal Reserve is offering to its local banks. At least that's the story, right? And again, what we're really talking about is shortage and scarcity. And so the dollar, the financial crisis in March told us, yes, shortage, scarcity, so short and so scarce that it disrupted the entire global system. The entire global system went into fire sale liquidation meltdown mode. Okay, so it was really bad. And what a lot of people are told to believe is that dollar swaps alongside QE and other methods were a way for the Federal Reserve to do its basic job, which is currency elasticity. And in terms of shortage, that means alleviating the shortage. And it sounds like these foreign overseas dollar swaps would be an effective tool to do that, right? The Federal Reserve is offering what it calls base money, what everybody assumes is base money, to foreign central banks who then redistribute it widely to all of these banks around the world who absolutely need the dollars. And it sounds like, why wouldn't it work? One reason why is, first of all, is you're pointing out, is it's a specific form of money, which is bank reserve, which is not necessarily a useful form of money in this global Eurodollar system. But what we can tell from the TIC data is these quote-unquote overseas dollar swaps didn't stay overseas. And in fact, what actually happened, and was absolutely clear from the banking data embedded within TIC, is that U.S. banks ended up with almost the vast majority, or even I think almost all of the dollar swaps that were offered, and you can see it. You see it absolutely clearly in the figures.
Jeff, am I showing the graph that shows that? Is that what this graph shows?
Yeah, and what this graph says, okay, first of all, there's two different series in TIC when we get into the banking data. The first is what U.S. banks claim on foreigners. That's not what we're showing here. That's what I call the blue series, where U.S. banks are lending dollars and securities and things to the offshore system. This red series is the opposite, because there's always a two-way flow here. It's not U.S. banks lending into the dollar system or foreign banks lending it. There's things going on in both directions all the time. So what we're seeing here in the red series is what U.S. banks are borrowing from the offshore system. That's liabilities to foreigners. So U.S. banks in this case are borrowing from their own foreign offices. So it's not like they're borrowing from a counterparty, completely arm's length transactions with other foreign central bank or other foreign banks. They're actually borrowing this dollar swap amount from foreign banks who happen to be their own offices. Either that can be U.S. subsidiaries of American banks, or it could be foreign parents who are lending dollars back to their American subsidiaries in the United States. But either way, it works out to the same thing. The Federal Reserve started in the U.S., offered dollar swaps, an unlimited amount for foreign central banks to access. They accessed about 400 some odd billion at the peak back in April, and therefore they took that 400 billion from the Fed and then offered it supposedly to banks in their jurisdiction, which is exactly what happened. But those banks in their jurisdiction then took those swaps from the foreign central banks and lent them back into the United States to either their American subsidiaries or their American parents. So these overseas dollar swaps, which were meant to alleviate this global dollar shortage and this wide, vast offshore outside the United States dollar system, didn't actually do that. All they did was go outside the U.S. and come right back in.
This is damning, Jeff. This is stunning. And tell me if I have this correct, if I'm explaining it to the audience correctly. We are told to believe that the central bank of the United States is central to the US dollar, that they know what they're doing. Am I correct in assuming that never in their wildest dreams did they imagine that sending dollars abroad into this complex system of nonlinearity and adaptation and emergence, this amazingly complex system of financial institutions, that money would then come right back? We're told that they're the center, that they know what they're doing. This seems like a complete failure. And if they knew this was going to happen, then I suppose, okay, they knew what they were doing and they just wanted to provide funding to U.S. banks overseas. That doesn't make sense. Jeff, is this a damning piece of evidence that you would bring up as an exhibit, People's Exhibit A or B or C at a trial?
Yeah, I think it is. And it goes back to, first of all, the scarcity idea and where the dollar actually is outside the euro. And number two, it goes back to what does the Federal Reserve actually do? So let's take the second part first. What does the Fed actually do? Well, the Fed just does a bunch of stuff. It basically just waves its hand in the air. It makes all this noise and sound and fury so that people believe things are happening. And then it puts very big numbers on these things, so it sounds very impressive. It's what I call the puppet show. And the reason I call it the puppet show is because it's not an effective, technically competent monetary program. It's all for show. The Fed doesn't care where the money goes because they don't know. They have no idea of knowing. They're just doing stuff to do stuff so that people are impressed that they're doing stuff, and then people begin to act in the way the Fed wants them to act. That's expectations policy, and here we are seeing a clear example of how it differs from actual money monetary policy. So what we would not expect is this ridiculous, absurd theater to take place where the world is starving for the dollars and the Fed supposedly offers them, but it doesn't actually offer anything useful. And that helps us explain why, when we go back to our dollar index view, why the emerging market index, for example, the trade-weighted dollar index for emerging markets is still up near the top. Because the emerging market currencies are the ones who are most vulnerable to a dollar shortage. And so if you believe that the overseas dollar swaps are the best way to alleviate a global dollar shortage of which the emerging markets are most susceptible to, then you would not expect to see something like this. However, if you realize, again, using the TIC data, what the Federal Reserve is actually up to, and it's nothing more than a bunch of drama and theater, then you would say, yeah, that makes sense. I understand why the emerging market currencies haven't really come back off the bottom, because they are still dealing with this massive dollar shortage and the problem that the Federal Reserve is essentially ineffective, powerless, however you want to characterize it, to alleviate scarcity, and the fact that the Fed is not the instrument that's going to be able to deal with that kind of scarcity.
Jeff, we're going to wrap up this segment by talking about the Chinese yuan, which is the heavyweight of the emerging market basket of currencies that the Federal Reserve uses as its emerging market US dollar index. But before we do that, I still want to go back just to that idea. I'm having a hard time understanding about the US Federal Reserve offering bank reserves to foreign banks via via their local central banks. Jeff, what good are Federal Reserve bank reserves all the way overseas to a bank in France, BNP Paribas or UBS? What are they going to employ those US dollar bank reserves that you can only use with the Federal Reserve? Am I correct that you can only use those with the Federal Reserve? And if I'm not correct, how would what is the thinking there?
Well, the thinking there is that it can essentially be a balance sheet tool to plug a hole. You're right. It's not very useful in a monetary sense, or at least in the real world monetary sense. But if you have a hole in your balance sheet, for example, you've lost repo funding because you own a bunch of junk on your balance sheet, you could potentially pledge some other junk, or maybe even the same junk, depending on collateral rules, with the local central bank. So if you're BNP Paribas and you've got the ECB who has these dollar swap lines with the Fed, and you've got a funding hole that emerges because the repo market is rejecting this junk, you could potentially post that junk collateral with the ECB instead of the global Eurodollar repo market. And so the bank reserves are useful in the sense of potentially plugging a hole in your balance sheet, which again is not exactly the same thing as, full on, complete, effective money in all its monetary roles.
Got it. Let us talk about the Chinese yuan and how it is behaving. Well, I guess we've seen this before with the Chinese yuan, because we've had 4 Eurodollar crises in the last 13 years. And in the third Eurodollar crisis, what we saw was that the Chinese currency was falling and their foreign exchange reserves were also falling. Now we see the Chinese currency again performing the cat-like hairball retching, but now we see foreign exchange reserves unchanging. What does that tell you regarding TIC and the US dollar?
Well, we got to put these things in order. Let's put them in order of cause and effect, okay? The first thing is TIC. TIC tells us scarcity, right? That's what we're defining. We're defining this proxy of the global Eurodollar system tells us, okay, something's going on, scarcity. The banking data in particular tells us that the dollar system is not behaving right. So when we expect scarcity, again, basic, simple economics, the price of the thing that's scarce goes up. So that's the US dollar exchange value. And again, if we're talking about China, the opposite of the US dollar exchange value going up would be the Chinese currency, the CNY or yuan, whatever you want to call it, going down. So we've got TIC that tells us scarcity. We've got currency translations telling us, yes, prices is behaving exactly as we would expect during scarcity. And the final piece is what the TIC data we're showing here, which is the holdings of US treasuries and other reserve assets, is how governments respond to that shortage. And what governments tend to respond, and usually through their central banks, what they do is they mobilize their reserves because that's what the textbook tells them to do. The Neo-Keynesian textbook says you have all of these foreign reserves in balance, on reserve. That's your insurance policy for this exact situation. And so when confronted with a dollar shortage, you sell some of these reserves, liquidate them so that you can fill in the hole because you assume it's going to be a temporary problem. So you sell your reserves, you give those dollars into the marketplace that the marketplace can't get from the Eurodollar system, and that buys you enough time for things to correct themselves. So we have all three pieces right here in front of us. The TIC data tells us in 2014, scarcity, dollar starts to behave, CNY starts to fall, and then by the middle of 2014, Chinese authorities begin frantically selling off their reserves, which I mean, that's a pretty good idea that not that it was just a dollar problem, but it was a pretty big dollar problem. And more than that, it was a sustained dollar problem, not a temporary one. So we have a really good complete story here from cause all the way to effect.
Jeff, I noticed that the currency surges, but the foreign exchange reserves didn't. And that was during globally synchronized growth. And that could have been a signal to us that something wasn't quite right? Because you and this article, right now we've been talking about how the US dollar is not really down. And then to provide an example to people as to how they would know if the US dollar really was down, you provide an example here. I'm going to read it out, quote, and I think what we're looking at, that graph there, kind of confirms that notion. Okay, so here we go. Let me read the quote. Quote, let's be simple and direct. A real falling dollar, like that which existed prior to 2008, and then again briefly in specific cases between 2009 and Eurodollar number 2 in 2011, would see Eurodollars, bank liabilities, flowing back into China. They aren't. If Jay Powell was flooding the world with liquidity, they'd show up there too they aren't. They didn't during globally synchronized growth relative to the increase of the currency, and they're not doing so now.
Yeah, and it's, again, we can see the same thing on the People's Bank of China's balance sheet, which is something I always go to as well, to confirm our story. It's the last piece of the puzzle. It's, what are the Chinese actually doing? And if the Chinese are not adding to their reserves, they're not adding foreign reserves or dollar reserves or U.S. treasuries into their stockpile, and that tells you there aren't dollars flying into China, which there would be if things were as we're being told they are. So the absence of those things is actually evidence of the absence of Jay Powell's flood and restoration and reflation, whatever you want to call it, in the dollar system. So it shows us, again, we have cause all the way to effect, including how governments are responding to the initial cause. And that initial cause in our consistent story through each of these different pieces and each of these different layers is what flood? Shortage. We're still dealing with a scarce system. And when we bring this back to the discussion about what the dollar's actually doing, if scarcity is going to continue to be a problem, it's going to continue to be a big problem, the dollar's not going to crash. It's just not, because there's nothing to make it crash. The Fed cannot. There's only two things that would make the dollar actually crash. One is the Fed actually printing money. But we know the Fed doesn't do that. We've gone through that numerous times. The Fed isn't doing it. And that's why we see the dollar outside of the euro remaining as high as it is. And the other part of that is what would make the dollar crash is what everybody else wants to talk about, which is China replacing the dollar system, the dollar losing its reserve status and everybody going to another currency. Which, quite simply, I always say, if they could have, they would have already. The fact that the dollar continues to malfunction the way it is, the dollar system continues to malfunction, and it's still in place, malfunctioning and harming everybody, and nobody's doing anything about it. It's very good evidence that the dollar is not going away anytime soon either. So there's neither the political nor the central banking ability to crash the dollar. There's only scarcity.
Jeff Snyder, head of global research for Alhambra Investments. You can read his work every week, his essay at Real Clear Markets. And this week's essay is on China and about China's supposed attempt to replace the dollar via the petro yuan. That's a good one. Check it out. But we are going to move on to part 2 of the TIC data, and it's going to get even more bizarre, even more Alice in Wonderland.